Thank you for joining with us again on a Friday evening for our weekly show, Ab India Karega Invest. I am Rishabh Lunia, the co-founder with Novice Learning Academy. Like every week, we have come up with yet another interesting topic for all of you. And today we'll try to understand more about passive investing and in specific about exchange traded funds, popularly known as ETFs. Before we move forward, let me introduce you to two of our guest speakers today. First, we have with us Mr. Sameer Desai, who is currently National Lead Sales at Nippon India AMC, formerly known as Reliance Nippon Life AMC. Sameer has got 30 years of experience in capital markets, covering areas like institutional equity sales, private wealth management, IFA group, ETFs, and indexing. He has 15 years of experience in ETFs while he worked with Benchmark AMC and Goldman Sachs AMC, and adding to that experience currently at Nippon India AMC. Welcome, Sameer.
Thank you, Rishabh, for having me over.
Yeah, thank you. Second guest of today is Mr. Hemen Bhatia. Hemen is currently Deputy Head ETF Business at Nippon India Asset Management Limited. Hemen has more than 15 years of experience in asset management industry in areas such as product development and business development, with more than a decade experience in ETF business. In addition to developing and launching various innovative ETFs, Hemen has been very instrumental in setting up CPSE ETF and was part of the core team which handled Government of India's first and innovative disinvestment by CPSE ETF. So I can very proudly say that we have two ETF veterans who will be handling this topic for us today. Thank you both of you for joining with us today.
Thanks, Rishabh, for having us.
So I think you would like to share the PPT, so you can share it, and then probably we can get going with our topic.
I mean, you can do full screen.
All right. So there are a lot of questions which actually our investor would want to know about ETFs. So first of all, if I may ask you, ETF has been really popular investment vehicle globally. But if you can help us giving us some overview in terms of global as well as the domestic ETF market, it will be really handy. And there are a lot of viewers who join us every week. So new investors who may not know what ETF is. So if first of all, if you can just explain in simple language what ETF is all about, and then you can give us the global and domestic perspective. So I think to you, Hemen.
Yeah, sure. See, as you rightly said, ETF has been one of the fastest growing financial instruments globally. So on the slide which is shared with everybody, you can see the volume of top 25 traded securities on US stock exchange. Okay, now as can be seen, the ones highlighted are different ETFs by different fund houses there. Out of 25 top traded 25 securities, almost 7 are ETFs. Okay, and against the perception that generally it is the stocks and the individual stocks which trade much higher than the ETF, you can see here that Spiders 500 ETF by Vanguard by Stacy it is the largest traded ETF on the US stock exchange. As against that, many popular stocks like say Apple and say Amazon, they trade at much lesser or say half the volumes of the Spiders 500 ETF. Now, what does this show? This clearly shows that a lot of investors globally are not only preferring individual stocks, but they are getting into ETFs, wherein they are investing into a basket of stocks. And the value-wise share, of these ETFs is before 15 years, I will say before 15 years, it was close to 18%. It has grown from there on to have 32% value share amongst the most traded securities, which we believe is quite huge. And coming to the AUM of the ETFs, the next slide. Coming to the AUM of the global ETFs, currently the size of the global ETF industry is almost $8 trillion. If we want to relate it with Indian mutual fund industry, it is almost 19 times the size of the Indian mutual fund industry. And as can be seen in last 5 years, from 2016 to say the current month, uh, the AUM, we've seen the AUM doubling globally from almost $4 trillion to close to $8 trillion now, which is huge, and which shows the popularity of the ETFs globally. Now coming to India, specifically in India, the size of the ETF industry is close to 2.9 lakh crores. And if you see the growth over last 6 years, it has grown almost 25 times. That is from 11,400 crores in 2014 to say 2.9 lakh crores currently. And in terms of the number of ETFs which are there, the number of ETFs are close to 100 now. So this has been the growth in India as well. And we believe that seeing these numbers, the global numbers and Indian numbers, even India has seen a very good growth over past few years. Obviously, there have been few factors which have led to this growth. We'll discuss those factors at a later point of time. Now, coming to your question on ETFs, what are ETFs? Savi, next slide. Now, ETF in one simple line is it's a mutual fund which is listed on the stock exchange. So it has all the key features of an open-ended fund as well as a stock. Hence we always say that ETF has best of both worlds. Of open like open-ended, it operates like an open-ended fund and has all the features of a stock. So specifically slicing down the one point on the exact features, key features. On the left hand side, you can see it's like a fund. By fund, we mean, see here, there is no active stock management or active stock picking or sector management which the fund manager does in a ETF. It is designed, it's a passive fund, and it is designed to track a particular index. For example, say Nifty 50 index or say Nifty Next 50 index. So there are no stock calls or sector calls taken by fund manager in a ETF. It's a passive strategy and follows a particular index. It's open ended. An investor can come in anytime and exit anytime, depending on their choice and their preference. Expense ratios also are relatively much lower as compared to active funds. So let me give you some basic average. Generally, ETF's expense ratio are between 15 to 20 basis points. As against that, if you take the expense ratio of a direct plan, the average expense ratio of direct plan active fund will be close to 1 to 1.5%. So that is the difference between the expense ratio of a passive and the active fund. And again, obviously, they are very transparent because at any point of time, you know that what the underlying of a ETF is going to be because it is mimicking the benchmark. On the right hand side, it has all the key features of a stock because ETFs are listed on the stock exchange. You have the trading flexibility to buy and sell ETFs intraday, just the way you do for any other stocks. You can even put limit orders while purchasing ETFs. Lot size again in line with the lot size of the stocks which are traded on the stock exchange. The lot size is 1 unit, and again, given that it's a mutual fund listed on the stock exchange, the delivery of your units is always into your demat account, as against a non-demat in your normal active mutual fund. So this slide gives you the basic overview of the ETF. Yeah.
Okay, so I think some important numbers you shared that out of the top 25, 32% is actually held by these seven ETFs. I think a lot of our viewers wouldn't have known that fact. And also, you mentioned that 2.9 lakh crore is the total AUM in India. So, if I may ask, what do you think? What are the factors which have contributed to the growth of ETFs in India? How it has multiplied so fast in recent times?
Yeah, sure. See, a lot of factors. So we'll say one of the biggest factor is the government trust on the ETFs given to the ETFs. So before somewhere in 2015, government of India allowed pension funds to start investing in select ETFs, say ETFs based on Nifty 50, Sensex, and any ETF meant for government divestment purpose. So earlier, before 2015, provident funds, there were no clear regulations on whether a provident fund can invest or not invest into equities. 2015 was we'll say a landmark year wherein this regulation was brought. And today, if you see, we believe EPFO is one of the largest institutional investors in ETF now, holding a mammoth amount of AUM in Nifty and Sensex and other few other ETFs. So pension funds, obviously, one of the key contributors. Even insurance companies on the institutional side, they were allowed to invest in select ETFs. So this was actually this regulation, and this came as a precursor to government doing the first disinvestment ETF in 2014. So insurance companies were allowed so that they can participate in the disinvestment of CPSEs via ETFs. And obviously, in 2014, we launched the first ETF meant for government divestment of CPSEs. So we were part at that time. We were part of the Goldman Sachs, and at that point of time, we launched this first ETF for government disinvestment. And from 2014 onwards, there have been multiple tranches of CPSE ETF, wherein we've raised thousands of crores for government of India and helped them divest their stakes in CPSEs. Another important factor, there's no STT on buying and negligible STT on selling of ETFs. So what used to happen earlier was there was actually a double incidence of double taxation, wherein investors used to pay STT on ETFs. At the same time, the underlying stock basket with the ETF buys, there was a STT to be paid on that as well. So in order to avoid the double taxation, the STT on buying of ETF was completely removed, and now there's negligible STT on selling of ETF. It's 0.001%. As against that, if you see the STT on stocks, buying and selling of stocks is 10 bits on each side. That's the STT charge for buying and selling the stocks. So apart from government measures, a lot of regulatory measures as well have helped in the growth of ETFs, and they've actually indirectly benefited ETFs. So one of them is obviously SEBI mandated all the funds in India to benchmark themselves and to show their performance against the total returns index. So total returns index has a dividend component built into it, and the dividends get added to the performance of that index. And price index is the one in which there is no dividend component which is there. It's X dividend. So most of the funds, what they used to do is they used to have get dividends in their schemes. At the same time, they used to benchmark themselves against price index. So almost, for example, Nifty 50 index, it has a dividend yield of almost 1.5%. So most of the funds used to show outperformance, or say alpha of 1.5% very easily, because your benchmarking was not correct. You were not benchmarking yourself to the total returns index which had dividend, so that apples to apples comparison could be done. So SEBI has corrected that, and now all the mutual fund schemes in India have to benchmark themselves to a total returns index. That has indirectly benefited ETFs because now it's apples to apples comparison while you do the active fund performance comparison. Another important factor, scheme categorization. So in 2017, SEBI came up with very clear guidelines on what will be the definition of a large cap, mid cap, and small cap. So your top 100 stocks are actually called as large cap. 101st to 250th stock based on market capitalization are mid cap, and 250th and beyond are small cap stocks. Before SEBI came up with this regulation, there was no clear definition on what a large, mid, and small means. Hence, different fund houses used to have their own definition, and they used to buy different kind of stocks of different MCAP based on their own internal criteria. That is completely gone now, and there's clear categorization as well. Now today, SEBI very clearly says that if you are calling your scheme a large cap scheme, you need to have at least 70% of your portfolio into large caps. So now, because of the categorization, because of clear-cut definitions, a large cap scheme will primarily have large cap stocks. As against that, earlier large cap schemes used to have good amount of mid cap, small caps. Hence, while you used to do apples to apples comparison, there was always some amount of alpha, etc., which was shown because of the incorrect categorization and because of internal definitions of large, mid, and small. So these are few of the factors which have contributed to such a sharp growth in ETFs in last couple of years. Factors helped by SEBI and helped by Government of India.
That was great, Hemen. Now I would ask Samir. Samir, generally passive indexing is, why do you think it's such a potent investment strategy? Because generally the understanding is that passive investing is more suitable for a developed market where it is possible for savvy investor or portfolio managers to consistently outperform the index in a country like India. So why do you think this strategy may work also in India?
Yeah, Rishabh, that's a very good question. And I think, as you rightly pointed out, there are a lot of misconceptions. In fact, the belief is that, in a market like India, you can have, talented or skilled portfolio managers who can consistently, identify good companies and, outperform the index. So why invest in the index? Now, indexing is the core philosophy or the core concept that drives an ETF. So, okay, so if I use an analogy, index is like the glacier from which the ETF river flows out. Okay, so it's very important to understand the indexing philosophy. And I'm reminded of a very famous quote by an American, investment advisor who wrote in an article some time back that alpha was always perishable, but in today's world of instantaneous information, it has the shelf life of unrefrigerated fish. So what it means is that alpha is very inconsistent for individual managers. And why is that so? As you can see on this slide, immense competition amongst professionals is what leads to inconsistent alphas or inconsistent individual alphas. So that does not mean that alpha will not be there. Alpha is there in the US also, but it is short-lived. And individual alphas are usually known in hindsight. So as you can see in this chart, you have almost nearly 36,000 registered entities in India who are in the business of generating alpha. Okay, these are the number of entities. This does not include, your treasuries, pension funds, family offices, and so many other entities who are also in the business of generating alpha. Okay, now if you, think of the huge quantum of CFAs, MBAs, CAs, economists manning these entities, then, you have a lot of competition, almost like a boxing ring, trying to box each other out in order to generate alpha. Okay, so I'm reminded of Professor William Sharpe's, paper, which he wrote in 1990. We all know William Sharpe because of the Sharpe ratio. But William Sharpe wrote something which is the foundation of ETFs and passive investing. And his paper, which was titled Arithmetic of Active Investing, what it said was, I'll just summarize that paper for, the audience. What it said was, mathematically, it is impossible for everybody at the same time to produce alpha. So if some investors or some professional managers generate alpha or outperform the index in a specific time period, then the others have to underperform to that extent. Okay, so mathematically, alpha generation is impossible for everybody at the same time because everybody in the aggregate is the market. So obviously, the market cannot outperform itself. Now, let me use a simple analogy to describe William Sharpe's zero-sum game in action. Let's consider the analogy of Mumbai local trains. In the Mumbai local trains, we see the zero-sum game every day. Okay, maybe not in the lockdown, but in a normal situation, at Churchgate or CST in the evening, a lot of commuters rush to catch window seats. Window seats are limited in number. Okay, so let's assume on Monday, a finite number of commuters caught window seats. They are outperformers. They generated alpha. As a result of that, the others are hanging outside or standing in the passageway. So they are the underperformers. Somebody like me and Hemen, we are the ETF. So we did not get the window seat, we got the other seat, but we reached Borivali in a risk-adjusted fashion. The guy who rushed to catch window seat, was it skill or was it excess risk? I think it was excess risk because you have to rush to catch the window seat. And you know what happens when, all of us have experienced what happens when trying to catch window seats. In the rare case, somebody can even fall on the tracks, which is the redemption of the scheme. Okay, so you are out of the game completely. Now, window seat catchers change every day. Guys who caught window seats on Monday, outperformers, may not be the same lot on Tuesday. Okay, they may be hanging outside, they may be the underperformers. Okay, so this, what we see in the Mumbai local trades is exactly what happens in the business of generating alpha. So, the zero sum equation gave rise to another important concept in finance, which is known as the paradox of skill. The paradox of skill tells you that when, a lot of competition is there amongst professionals, ironically, luck may play a greater role in the final outcome. So, it is not easy to measure that in a particular alpha, how much was luck and how much was skill. Now, if I have to eliminate this, important factor, okay, if I get to know the alpha guys always in hindsight, past performance, okay, which may not repeat in the future, then what do I do? Then I have to buy the national cricket team, which is the index. The national cricket team is always going to be there. Individual players will keep coming and going out of the national team. But your Nifty 50, for example, the Nifty Next 50, I'm considering two large cap indices, are like your national cricket team, which is always going to remain. So bet on a portfolio which is your national cricket team. Okay. So if you have a Nifty 50 ETF, for example, and Nifty Next 50 ETF, okay, you will keep getting the return of the index, whatever it is going forward. So let's assume historically the return of the oldest ETF in India, for example, till date has been about 15 to 16% CAGR. At least this was capturable. Going forward, I don't know what is going to be the return, but it is going to be very difficult to identify who is going to catch the window seats, who is going to hang outside. So if I want to eliminate that process, then I have to necessarily put my money in the index. So, I would like to use two more analogies to make this, very, very clear. I always say that indexes don't change jobs. They don't demand bonuses. They don't demand ESOPs. They don't take sick leave. They don't take vacations. They don't quit companies. Indexes are always working for you. So invest in something which is working for you 24 by 7 by 365. And I'm going to use one more analogy from sports. If outperformers are gold medalists, underperformers are bronze medalists, then index is silver medal by default. Okay. So you will always be in the silver medal position come what may. So don't waste your time in trying to do what cannot be achieved. Bring down the risk of prediction, which stocks will do well, which managers will do well. Buy the market via index ETFs. Okay, this is what I want to say from this slide.
Thanks, Amir. I think very, very simple way of explaining and those interesting analogies. I'm sure our viewers are liking the way you are explaining. Next, I would move to Hemen again. Hemen, I think in your first couple of slides, you mentioned that ETF is more like a mutual fund and a stock. It's like a combination. But can you just give us some more into it, like how ETF versus stock versus mutual fund, if somebody has to decide onto it? Yeah.
Yeah, sure. The one important thing difference between ETF, stocks, and mutual fund is one is ETF. Given that ETF is listed on stock exchange, okay, you can trade ETF real time, just the way you can trade stocks, which is not possible in case of a mutual fund, because mutual funds are not listed on stock exchange. You can't trade them. You will get end of the day now while you invest in any mutual fund which is not listed on exchange. So first and foremost important point is, from trading perspective, ETFs and stocks you can trade on stock exchange, whereas mutual fund you cannot. Another is limit orders. As I said, like stocks, you can put limit orders in ETF as well, but same is or not possible in a mutual fund scheme, because obviously it's not listed on stock exchange. Apart from that, see, a lot of investors can who do cash and futures arbitrage. They can do cash futures arbitrage using ETFs in cash market and stocks in cash market. but the same is not possible in case of mutual funds. Other than that, in terms of diversification, as we all know, while you invest in any mutual fund, be it a ETF or open-ended fund, you are actually diversifying by buying one unit. You are buying the whole basket, the whole portfolio. So that diversification is possible in ETFs as well as mutual funds. Whereas the diversification benefit is you will not get the diversification benefit if you are buying few individual stocks. Market returns, again, I'll say this feature is specific only to ETF. Given that ETF is constructed to track a particular index, you will not outperform, and you will neither you will underperform. Your returns will be close to the market returns less the expenses charged in the ETF. Whereas the same can not be said in case of individual stocks as well as active mutual funds. There you can either outperform or you can even underperform. Intraday, again, given that ETFs are listed on the stock exchange, similar to stocks, you can buy and sell ETFs anytime, unlike mutual funds. And exit loads in ETFs, you can enter anytime and exit anytime. On exit, there's no exit load, whereas a lot of mutual funds have exit loads charge if you redeem the units within the certain period from the time of your investment. So these are few of the key features. Most of the features are common between ETFs and stocks, and few of the features are common between ETFs and mutual funds. Hence, we say that ETF is best of both worlds.
Superb. So I think that was quite clear. Now I think our viewers know how mutual funds, ETF, and stocks are different from each other. Now you mentioned that there are more than 100 different ETFs available in India. So while selecting any particular ETF, what all factors our viewers need to keep in mind? If you can just quickly share some of them.
Yeah, sure. See, there are three key factors for selecting any ETF. The first factor is exchange volumes. While I talk about volumes, you higher the volume of a ETF, better it is. Why better it is? Because higher the volume, you will get a fair price of the ETF on the stock exchange. And as an AMC, Nippon India ETF offers a facility to investors to track the real-time NAV of our ETFs, so that while they are buying and selling on the stock exchange, they can refer to our website and see whether they are getting a fair price. And that fair price is only possible if the volumes in the underlying ETFs are higher, wherein more and more investors are trading in that ETF. So obviously, exchange volume, one of the key factors. Second most key factor is tracking error. Now, tracking error is the acid test for a ETF fund manager. The fund manager does not take active calls, sector calls, or stock calls, but the fund manager has to ensure that at any point of time the ETF is tracking the underlying index as close as possible, and hence lower the tracking error, better it is, better the ETF is, and it shows that the underlying fund is being managed well by the fund manager who is handling that ETF. Third most important point is expense ratio, the TERs. So lower the expense ratios, better it is, because penny saved is penny earned. Hence, it becomes very important that while you select a ETF, you select a ETF with lower expense ratios. Now, here I would just like to put one caveat. A lot of time, investors are of the belief that always a lower expense ratio fund will be better. Now, think of a situation wherein the expense ratio of a fund is, say, 5 basis point annualized, whereas its tracking error is 50 basis points. So in this case, what happens is you try to select one ETF with very low expense ratio, but if that ETF is not being managed well, your tracking error of 50 basis points is indirectly going to eat into your returns. So you will be better off in a, for example purpose, in a 10 basis point fund, but with a much lower, relatively much lower tracking error. So while selecting a fund and while considering the expense ratio should not be considered independently, but it should be considered on relative terms. And while I say relative terms, relative to the exchange volumes and the tracking error. Independently, expense ratio should not be the only deciding factor for investing in the ETF. So to summarize, three key factors: exchange volume, tracking error, expense ratio, higher volume, better it is, lower the tracking error, better it is, lower the expense ratio, better it is, but relative to the exchange volume and the tracking error.
Yeah, I think that was pretty clear. And because a lot of investors we see that they chase the expense ratio. So I think that's a quite a good disclaimer that don't chase expense ratio. It is to be seen in the relative terms. So thanks, Hemen, for that. Now I would go to Samir again related to the cost, because a lot of investors give a very high importance to cost. But don't you think that the Indian markets give high enough returns so that we can overlook the cost factor, or it is still very important?
Yeah, Rishabh, I think cost, one needs to look at cost in two ways. One is the normal way of looking at cost. So, for example, if let's say I pay more, I get a better quality mobile phone, okay, with more features. Similarly, if I pay more, I may get a better car than maybe a hatchback, okay. And practically, this holds true for every goods and service. But this is not exactly the case for investment products, and especially when it comes to ETFs, because in investment products, cost eats into the return. Okay, cost works like termite. Okay, just like termite eats away into furniture, cost eats away into the return. Okay, and it doesn't necessarily mean in investments that if you have a high cost product, okay, you may get a higher return as compared to the ETF. That may not necessarily hold true, like it holds good for mobile phones, cars, and every other goods and service that we normally avail of. Okay, so if you have, for example, let's say over the next 10 years, let's say a low cost ETF, Nifty ETF, gives you on an average 15% CAGR, and let's say an alpha large cap fund gives you the same return. Okay, then merely on the cost differential, the fund manager will underperform the ETF. Okay, or to put it in a different way, just to overcome that cost hurdle difference between an ETF cost and typical active fund, large cap active fund. So let me throw some numbers. So let's say you have a Nifty 50 ETF costing 5 basis points, which is the annualized expense ratio, and you have the direct plan of an active fund. Let's say, for argument's sake, that on an average the cost is 100 basis points. Okay, now merely on the cost, the fund manager cost differential, the fund manager will, it sets a very high hurdle for the fund manager. So the cost is very critical in investments. And as I said, even if you chose a high cost fund, it is not necessary that you will outperform a low cost ETF. In one of the subsequent slides, we'll see the Indian data, and where it will become very evident how the high cost funds are doing. So, I'll again end with a simple analogy. Let's say somebody has to get a daughter married after 10 years. Okay, and he's investing in an ETF, and another gentleman is investing in a active fund which is costing about 20 times more. Okay, in terms of expense ratio, and both gave the same returns over the next 10 years. Then, merely because of the cost advantage, the ETF father will be able to invite more guests to his daughter's wedding than the alpha fund father. Okay, so both invested, got the same return, but merely on cost, the ETF father did much better, and therefore he was able to invite more guests for dinner to his daughter's wedding than the latter. So this is how cost is very important in investments.
Thanks, Samir. I think our viewers have now getting more clarity, like how much they can benefit by investing through ETFs. Now, again, moving to Hemen. Hemen, ETF is primarily based on the philosophy of passive investing. So, what do you think? What kind of investment strategies we can formulate using ETFs? If somebody wants to use ETF in their portfolio from strategy point of view.
Yeah, sure. So see, there's a belief that ETF is a passive vehicle. It's quite boring. Nobody is picking the stocks. Nobody is choosing the right kind of sectors, etc. But let me tell you, the underlying underlying investment strategy of an ETF is passive. That is actually helping you eliminate a lot of non-systemic risks like stock picking, sector picking, etc. But as an investor, you can formulate your own strategies in an active way. The investor need not be passive while formulating their strategies. The underlying is passive, helping you eliminate non-systemic risk. But as an investor, you can do a lot of things. Samir, the previous slide. The first strategy, what we've done is we've created we've put 5 strategies in 2 slides, and practically in real world, every investor can be boxed into one of these 5 strategies. Okay. Now, first and foremost, the strategy on asset allocation, widely used across the world by most and lot of investors. So while planning the asset allocation or while formulating the asset allocation of a particular investor, you can actually use ETFs as an underlying, because ETFs are very flexible tool, and they can actually help you get exposure to a particular asset class by just buying one or two ETFs. By buying one or two ETFs, you can get exposure to, say, equity as an asset class. You can get exposure to, say, asset class like of commodity or slash gold by buying any gold ETF. So investors can actually use underlying ETFs to formulate their asset allocation strategy, because ETF is very flexible in terms of what they can buy and sell, and it can represent a asset class. On asset allocation specifically, Samir, would you like to add anything before I move on to the next strategy?
Yeah, so asset allocation, clearly a lot of studies have told us that asset allocation is the prime driver of returns. Okay, 95% of your portfolio returns come from asset allocation. Only a small component comes from timing the market, security selection, and so on and so forth. And asset allocation, very simply, is diversification across asset classes. So the human body needs vitamins, proteins, carbohydrates, fats. This is asset allocation. Indian thali is asset allocation. Dal, chawal, roti, sabzi. This is asset allocation. Okay. So asset allocation can be best practice using indices, because indices are true representative portfolios of an asset class. For example, Nifty 50 represents the large cap category. An individual large cap stock or an actively managed large cap scheme cannot be representative of the large cap segment, because it will have its own unique characteristics, risks, etc. Okay, so if asset allocation is the prime driver of returns, and if indexes are the best, are portfolios that are true representatives of an asset class, then asset allocation can be ideally practiced using index ETFs.
Yeah. See, the next important strategy with a lot of institutional investors, or say market investors, use is cash equitization. Samir, the previous slide.
Yeah.
Is the cash equitization. So what happens in case of cash equitization is, while you are trading the stocks, and you sold some stock and you don't have a next idea, okay, which stock you want to buy next. Till the time you decide on your next idea, you can actually invest in certain broad market based indices like the Nifty 50, or say you can have sectoral exposure to a banking ETF, etc. So that till the time you decide your next move, you don't miss the market movements. So cash equitization is also one of the strategies which is very much used across institutional investors, as well as a lot of investors who trade into stocks. Now, third strategy is core and satellite. I think this is one of the one of the key strategies which every investor should ideally use as part of his portfolio. So, core and satellite, we always say that an investor's portfolio should be divided into core and satellite. Core should be your market giving mutual fund, or say the beta of the market, and your satellite can be any of your alpha generating funds, be it mutual fund, be it stocks, be it PMS, AIFs, anything which can generate alpha. Now, in the core portfolio, which should be your majority of your portfolio, you should at least capture your beta, because alpha you don't know. Alpha, while in the quest of searching the alpha, you don't know whether you will get the alpha in the underlying fund where you have invested your money, you don't know whether you will get the alpha or not. But you will at least be assured that if your core portfolio is your ETFs and say passive funds, you will be assured of the market returns, which is your beta. So core and satellite should be used to construct any investor portfolio, and we believe that core should always be your passive funds. Hence, as a strategy, passive and active fund both can actually coexist with each other. It is not either or, basically. Be it active funds or be it passive funds, both can coexist with each other. You just need to formulate your portfolio into core and satellite and use both the strategies as per your requirement. The next one is so a lot of investors who do their strategic allocation over a period of time, they can actually actively manage their long-term portfolios by getting into certain sectors and by getting into certain favorable sectors and getting out of non-favorable sectors. For example, today we have a sector funds on say bank ETF, or say we have sector funds on say IT ETF. uh, uh, so a lot of these sectors wherein an investor has a particular view and wherein they want to take a view based call, they can actually actively manage their long term portfolio using the ETFs based on the sectoral funds. Apart from that, a lot of investors who trade into the market, who take a view on say broad indices like say Nifty, or say a lot of investors trade into bank Nifty as well. There also a lot of those investors can actually use Nifty ETF or say banking ETF in cash market. It becomes a very easy tool rather than getting into futures, basically entering into the futures of that particular indices. So ETFs can be used in for trading as well. So these are the 5 key strategies wherein I think most of the investors can be boxed, and most of them can use these strategies actively. Yeah.
Thanks, Hemen. I think it was very perfectly explained that a lot of investors can use ETF, because earlier people thought that it's passive, so it has limited application. But I think now you've made it very clear that it can be used in multiple ways. So my next question would be to Samir again. It is said that Indian markets are relatively not as efficient as developed markets. So hence alpha generation is relatively easier in India. So what do you say on that, Samir?
Yeah, actually, Rishabh, the word passive is a misnomer. Okay, so it's quite misleading. So passive is very potent and lethal. Is now evident from the Indian data, which is there on the screen right now. Okay, so this is the SPIVA, stands for Standard and Poor Index versus Active. This is the standard measurement globally for alpha funds versus indices. Okay, and this has been this exercise has been done in India for the last decade or so. So there are 2 sets of data. One is the old Indian data, which is on the top part of the slide, and one is the latest Indian data. So let me go to the latest Indian data, which is for a time period ended December 2020. So this is large cap funds. Now, as for example, for a 3 and 5 year time period ended December 2020, more than 85% of large cap Indian mutual fund schemes have underperformed the indices. So this is the percentage of funds outperformed by the index. Okay. So these many fund managers have underperformed the indices. Okay. If you go to the ELSS space, okay, the Indian ELSS space, the results are equally compelling in favor of the indices. What this tells us is that Indian markets are efficient. What do I mean by efficiency? Efficiency means it is very difficult for a manager to find victims to exploit. What do I mean by that? A fund manager can outperform if somebody makes a mistake in the market. Okay, so if he can capture pricing errors or mispricings in the market, or what we call pricing anomalies, okay, then he can cap increasingly by professionals of all kinds. Who is going to make a mistake? Okay, so since you have professionals, who are the large component of stock pickers, the pricing errors or the mispricings in the market reduce. And that is why Indian markets are efficient, leading to inconsistent alphas or short-lived alphas for individual managers. Okay, so alpha is increasingly transient. It is perishable. It has the shelf life of unrefrigerated fish, which I said right in the beginning. So this data tells you that for a long term, okay, you should bet on the index, because index is the only portfolio which you can take a long-term view. If I want to take a 5-year view or a 10-year view, I don't know who is going to outperform, who is going to underperform, who is going to be around. Okay, all those things are very difficult. And that is why none other than Warren Buffett, not once but time and again in his various annual reports, he has spoken about the advantages of index investing. So he says that most investors, or rather an overwhelming majority of investors, should put their money in the indices. Okay, so this is your Indian data for you. Let me just quickly go through this data. This is a old Indian data for a 5-year time period ended December 2009. Almost 71% of large cap Indian mutual fund schemes had underperformed the Nifty. And this is before SEBI classification, which Hemen spoke about. Okay, so see, SPIVA always did the SEBI classification. I mean, they always did the proper benchmarking and other scientific parameters. Just let me mention one or two parameters which they consider. So one parameter which they consider is known as survivorship bias. What does this mean? Supposing you have 50 large cap alpha funds in the sample available, from which, let's say, you want to pick and choose and start an SIP. Now, it may so happen that after 5 years, all the 50 funds may not survive. The bad performers will either be shut down or merged into better performing schemes. So data will get biased in favor of survivors. This is known as survivorship bias. So this correction or this adjustment is done in the SPIVA data. SPIVA also does proper benchmarking, apples to apples comparison. If you have a large cap, alpha fund, necessarily the benchmarking will be done to a large cap index. So scientific parameters are considered by SPIVA, and this is how you get the result of the SPIVA measurement.
Thanks, Samik, for that insight. Now, I think the biggest question which I think our viewers would be waiting, like how can we invest now, because they have understood the concept. I think some of them would have definitely liked that this is definitely a must go in their portfolios. So how can they invest in ETF in Indian markets?
Yeah, sure. See, investment in ETF is very simple. It's exactly the way you invest in any other stock. For example, you just have to buy, similar to how you buy your stock from your stockbroker. Just log into your account and buy an ETF. Given that ETFs are listed on the stock exchange, the settlement cycle of the ETFs is exactly the same as any other stock which is on T+2 basis. The units are come to investors in demat form, similar to how it comes in the stock. Now, there's one more way of buying ETFs, and that is when investor can come directly to the AMC. But there are certain investors can buy only in certain lot sizes. For example, if you want to buy a Nifty 50, say our Nifty Bs, there the lot size is almost say 50,000 units, and in rupee terms it may come close to 70 to 80 lakh rupees. So for different ETFs there will be different lot sizes if you want to come directly to the AMC. The directly with the AMC route is mainly being used by, I'll say, large investors and large investors who can buy in those lot sizes. But for retail investors, we'll say very simple, similar to how you buy the stock on the stock exchange. That is exactly the way you buy a ETF.
Thanks, Evan. I think that was quite simple to understand. Now, I think Nippon has been a pioneer in ETF in Indian markets. So, if you can just take us through quickly, what are the various schemes which Nippon has got so that investors can benefit from them?
Yeah, see, Nippon India, we believe, is one of the fund houses which has a dedicated team doing only ETFs, So we all were part of Benchmark Mutual Fund, which pioneered ETFs in India, which started ETFs in India in 2001. And from there on, we have moved to Goldman, Reliance, and now Nippon by way of various business acquisitions for ETFs specifically. So we can say that we are a ETF specialist team. And along with us, all our products have also moved to in our current form to Nippon Mutual Fund. So three key parameters. Basically, I'll say one is the volume share, one is the folio share, and one is the AUM market share. So volume wise, as seen on the slide, almost 73% volumes on the stock exchanges are from are of Nippon ETFs. If you take the average daily volumes of say last 1 year, folio wise, almost one third of the folios or say investors who are there who trade in ETFs in India are Nippon India ETF investors. Market share wise, we have almost 13% market share in terms of the total EUM. But if we exclude the EPFO money and say the private the pension money which is going into certain select schemes, then we are number one private sector ETF AMC with the largest share of almost 38 to 40% share in the EUM. And in terms of the track record, as I said, we started ETFs in India while we were during our benchmark days. Benchmark Mutual Fund pioneered ETFs in India. So we have a strong 19 to 20 years track record in now managing the ETFs. And volume wise, I'll say a lot of our popular products, say flagship products, have much higher volumes as compared to the industry volume. For example, Nifty Bees. This was the first ETF launched in India. If you see its daily average volumes, its volume is almost 39 to 40 times the of the industry average. A banking ETF, which is again very popularly used by investors for having banking exposure, its volume is almost average volume is almost 28 times the industry average volume. And apart from that, a lot of our other ETFs like say gold, bank, PSU, they are actually largest among the respective categories. And specifically on the investor base, we've seen that in last 1 year from the time the COVID started till the time we saw the market boom, we've seen our investor base almost doubling from 9 lakhs, close to 9 lakhs in last March to close to 19 to 20 lakhs now, which we see, which is practically the highest ever investor base and investor addition in the history in over last 20 years, which very clearly shows that more and more investors are preferring ETFs. Now, specifically coming to the ETF basket, so we have one of the largest ETF basket spread across 22 ETFs across asset classes, that is equity, fixed income, and commodity. Majority of our AUM is into equity ETFs. Within equities, we have domestic as well as international indices. Within domestic, also we have the different segregations, that is broad market based indices, sectoral indices, and thematic indices. So under broad market, I'll just name the few popular ones. Nifty Bees tracks the Nifty 50 index, very popular. Sensex ETF is one which we have. Junior Bees, which is a Nifty Next 50 companies, a very popular ETF, and one which has given consistently almost 19% CAGR from 2003 till now. So Junior Bees is the ETF we have on Nifty Next 50 index. We also have Midcap 150 ETF, in which we capture the midcap segment, which is your 101st to 250th stock as per the market capitalization. On the sectoral side, we have banking ETF tracking the banking sector as a whole, PSU Bank ETF, specifically if somebody wants to invest only in PSU Bank. We have a ETF here. We launched IT ETF in last year in last June, and we've seen very good response in that as well. From 20 crores to current AUM is close to 900 crores. Shows the popularity of the product and the investor's choice. On the thematic side, we have CPSE ETF, which is used by Government of India to do its divestment. Apart from that, we have an infra fund also tracking the infrastructure sector. In addition to this, we also have one smart beta strategy, which is your value strategy. So a lot of time investors have a preference towards value growth and value strategy. So we have a value strategy here, which is like NV20. The fund is called NV20 fund, NV20 ETF. So out of 50 Nifty 50 stocks, 20 value stocks are chosen based on certain value parameters by the index provider, and we have a ETF which tracks that index. We have a ETF on consumption. Somebody wants consumption as a theme, or say dividend, or say higher dividend as a theme. We have ETFs on that as well. On the fixed income side, I'll say uh, uh, we have a money market. We have liquid Bs, which is actually a overnight fund used for in between trades for placing your in between orders while you sell a fund, and you don't want to keep your money ideal. You can place it in liquid fund. So we have a liquid fund. This was the first money market fund to be launched in India. We have funds on different yield curves, say 10-year yield curve, which represents the long-term yield. A 10-year yield curve, if somebody wants to ride on the 10-year yield curve and has a view on the 10-year yields, we have a ETF for that. We have a ETF to play on the 5-year yield curve as well. And apart from that, we've launched two funds which are becoming more and more popular based on the target maturity concept. So we have two funds. One is maturing in 2024 and another in 2026, having underlying as CPSCs and SDLs. So there's no credit risk which is taken by the fund, and there's no call which is taken by the fund manager. We are mimicking a particular index, and it is actually helps. It actually acts as an alternative to FMPs because you can buy and sell these funds anytime. Apart from that, obviously international fund. I forgot to mention it. We have one international fund as well on the benchmark to the Hang Seng Index, and we will have few of them as well in the coming few months. On the commodity side, again, we were the first ones to launch a gold ETF in India. So again, a very popular product. While investors want to do their asset allocation and want commodity as part of their portfolio, gold ETF in terms of the AUM, it is the largest ETF, and even in terms of the volumes, it has the highest volumes against all other gold ETFs in the industry. So this is our overall bouquet. Almost we've tried to launch our products in such a manner that investors can easily do their asset allocation and do different kind of strategies with them on. And it's a growing bouquet. If we feel the need and if there's a demand, we'll keep launching various other ETFs in future as well.
Thanks, Hemen. I think that was a very, very, I think, detailed one. So investors have got a idea of what are the choices available with them in terms of their core portfolios, in terms of their satellite portfolio, and even when they're looking at as an asset allocation strategy. So perfect. I think we have got a lot of questions related to ETF. So I think because you were discussing about gold ETF, so I will first take a question related to gold ETF which has come. Our investor wants to know what is a comparison of somebody who's making a choice between a gold ETF versus a gold mutual fund and versus a sovereign gold bond fund. So
Um, See, I think this question can be very lengthy to answer. So, I'll just give you a few key features. So, between gold ETF and gold fund, I'll say, in case you have a demat account, and then you should go ahead and buy a gold ETF and not get into a gold fund. But if the facility of demat account is not available to an investor, then investor should go ahead and buy a gold fund. Because in case of gold ETF, the underlying is physical gold, whereas in case of gold fund of fund, the underlying is going to be the gold ETF. So because it's a fund of fund on gold ETF, there will be additional layer of expense ratios charged in a fund of fund. So investor who is having a demat account will always be better off in a ETF. But in case you do not have that facility, you can use a gold fund of fund. Coming to difference between gold ETF and sovereign gold bonds, I'll say both have their own pros and cons, because in a sovereign gold bond, see, there are tranches in which you can invest in sovereign gold bond, right? You cannot invest anytime and you cannot exit anytime. You have to wait for government or say RBI to come up with those tranches. Whereas in case of gold ETF, you can buy anytime and sell anytime. You are not dependent on anybody. It's your choice and your view wherein you want to enter and exit. So that is one big difference. Another key difference in favor of sovereign gold bonds is RBI pays you interest on sovereign gold bonds, whereas in case of gold ETFs, you will not be paid any interest, because we do not earn any interest on physical gold. And our gold ETF has 100% physical gold as underlying, and we cannot pay any interest to the investors. So that is a point for the sovereign gold bond. Apart from that, I'll say one more deterrent, I'll say, for sovereign gold bonds, or I'll say one disadvantage is you have to, there's a lock-in in case of sovereign gold bonds. So you have to, although they are listed on the stock exchange, there's not enough volume for any investor to enter or exit at any point of time. So I believe there's a lock-in of 5 years, minimum 5 years, and post which they provide you the facility to redeem. Whereas in a ETF, there's no lock-in. It's your choice. You enter anytime and exit anytime on stock exchange. So again, and last but not the least, see, in sovereign gold bond, you are actually taking exposure to a bond. Okay, lot of time when an investor gets into a gold ETF, you actually want to have exposure to a to a completely different currency. So gold is actually being used as a currency, right? It's an alternative currency. So if your objective is to hedge yourself against any unforeseen circumstances, etc., here there you have physical gold as underlying, whereas there you are betting, you are actually taking a credit risk. Obviously, the credit risk, while I say credit risk, it is the bond is being used by RBI, so it's the sovereign risk. But again, there is some amount of credit risk there, as against no credit risk in case of gold ETF. So these are few pros and cons of gold ETF versus SGB and say a gold fund of fund.
Thanks for that. And there's another question which our viewer has asked relating to stocks and ETFs. Like, does ETF provide dividend like a stock?
Yeah, so whatever dividends get accumulated in the ETF because of the underlying constituents paying those dividends, it gets accumulated and it gets reinvested into those stocks. So let me tell you, we used to pay dividends before a couple of years, but if you see the taxation rules, they have changed in last few years, and now if I pay a dividend, it is taxed in the hands of the investor based on the marginal rate of return. So a 30% tax bracket investor will lose the taxation additional, will have to pay additional tax to the extent of I'll say 15 to 20%, because if I pay the dividend, they will have to pay 30% tax on the dividend. At the same time, if they sell the ETFs, the capital gain, the short term capital gain is 15% like any other stock, and long term capital gain is 10%. So as compared to the dividend taxation, the relative taxation is, in case you sell ETFs, is much lower. Hence, the investor will be better off selling a ETF and booking the profit rather than we paying the dividends to the investor. So we are actually helping investors save taxes by not paying dividends.
That is interesting. Another investor wants to understand whether ETFs are tax free in India, or what is the tax slab if they are taxed.
Yeah, so the taxation of ETF is exactly the same like any other mutual fund and like any other stock. 12 months is your long-term period which is considered, and if you hold your unit for more than 12 months, 10% is the taxation you have to pay while selling, and for short-term, which is less than 12 months, 15% is the taxation you have to pay. Obviously, your cess and education cess and all other statutory charges are over and above the base tax rate. Similar. So the taxation is exactly like mutual fund, and I'll say which is similar to any other stock taxation.
All right. So another viewer wants to know that he doesn't know anything about stock market. Can ETF be a good way to start investing into markets?
Yes, so let me tell you, a lot of investors who open demat accounts. So you've seen our investor base also rising. I showed you some slide. So that is corresponding to the rise in demat accounts which have been opened in last 1 year. So lot of stockbrokers offer ETF as a basic investment vehicle to the investor while they open their account, rather than getting into stocks and giving them views. Investor will always investor who is just starting in the capital markets, he'll be better off investing in a simple fund like say a Nifty 50 fund or say Nifty Next 50 fund, wherein the investor is just getting the market returns in line with the performance of the underlying benchmark. So yes, for investor who is starting, we believe ETF will always be a very good vehicle because there's no stock picking or there's no additional risk which you are taking. A lot of non-systemic risk get reduced while you are investing in an ETF. Samir, you would like to add something?
Yeah, so I'll just add to what Hemen just said. See, a first-time investor, in fact, straight away can sign up for an ETF SIP.
Yeah.
Okay, SIP is a very popular mode of investment. It's diversification across time. So I think an ETF SIP is something that you can sign up for the long term. Because supposing, let's say I sign up for an ETF SIP into, I'm just taking an example, into a Nifty 50 ETF and a Next 50 ETF. Okay, I'll at least get the index rate of return, whatever it is going forward. See, that is assured. Okay, and the index rate of return in India has been good enough to beat inflation. Okay, which is the primary purpose of putting money in equities. So I think as long as I can do that, I know a portfolio which is long term, which is always going to be there. There's no chance of underperformance, and it's low cost. So I think SIP is very good. This is something that an investor, first time investor, can do straight away.
Thanks, Samir and Hemen, for that. One question on the bond versus bond ETF.
Yes.
So, what are the benefits of investing in a bond ETF when compared to direct investing in bonds?
So let me tell you, one of the biggest advantages you get in a mutual fund is the underlying interest which will be paid, or say the coupon which will be paid in a bond, it will be taxed based on a marginal rate of return, right? Similar to dividend, how it happens in happens to dividends in equities. Here, in case of bond ETFs, or say target maturity fund, the underlying coupon which we received will be reinvested, and the long term taxation in case of debt funds is 36 months, and 20% with indexation. Short term taxation is based on your marginal rate of return. So if an investor is holding a mutual fund unit for more than 36 months, taxation wise, the investor will be much better off holding the same bonds in the mutual fund format. So I'll say one is taxation is one of the biggest advantage while you invest in a target maturity based ETF versus the bond which the underlying ETF will be holding.
Perfect. And I think one final question, I think more than a question, I think it's a concern on the liquidity front, because how the ETF liquidity in India is moving.
So again, see, the liquidity of a ETF is actually dependent on the liquidity of an underlying. So while talking about the key parameters, we highlighted that exchange volume is one of the key parameters. Now, if you see the exchange volume of few of our popular ETFs, for example, Nifty ETF or Nifty Bs, it trades close to 15 to 20 crores a day. The liquidity in most of our popular ETFs is quite high, and because apart from the market makers which provide liquidity in our ETFs, the number of folios which are number of folios representing the number of ETF investors in India, we have one of the highest share in that. Hence, apart from the market makers providing the liquidity, there's a lot of natural liquidity which is there in our ETF, because there is a lot of natural investors who at any point of time want to buy and sell our ETF. So liquidity, we don't see liquidity as a concern in most of our ETFs. I cannot comment on the other ETFs in the industry, but at least for our ETFs, I can say that liquidity is not at all an issue, and the numbers are in front of you. Nifty ETF, I said to you, almost our if you take the average volume of Nifty 50 ETFs in the industry, Nifty Bs is almost 39 times the total volume. So that's the difference. I cannot show a lot of numbers here, but you can go on the exchange and just check the volumes of most of the Nifty 50 ETFs. You will see huge difference in the liquidity of our ETF versus others. So in case of our ETF, we don't see liquidity as a challenge, and investors can comfortably get in and get out anytime at a fair price.
Yeah, I think that was great, Hemen and Samir. I think that was the last question, and I think the way you have explained the entire concept of ETF, I'm sure our viewers now would have got a great hang on the subject, and they are ready to start their ETF journey if they have not started yet. So, thank you so much for your insights into this interesting topic of passive investing. And I think very interesting analogies which you gave, and you made the entire session quite fun. Thank you joining with us today for the show.
Thank you. Thanks a lot.
Thank you. Thank you, Rishabh. Thank you. Thank you.
Thank you, viewers, for joining again on a Friday evening. And again, it was a pleasure having you here. Again, we will catch up with you next Friday with a new topic and some guest speakers from the industry. So till then, stay safe, stay healthy. Thank you. Bye-bye.